Welcome to all of you to today's seminar. It's a pleasure to see you all for this final episode of a series of 3 webinars that we had on how financial markets price climate risk. For those who didn't have the chance to follow the previous webinar, we started this series 1 month ago with Stefano Giglio, February 14th, who presented his paper, Climate Finance. And 2 weeks ago, we heard from Michela Scatigna and Omar Zulaika on the pricing of ESG criteria on financial markets, a study that they have done for the BIS. Today, we conclude this series with a policy panel in which we will hear the conclusions that our panelists take out of academic and central bank research on climate risk pricing by financial markets and financial institutions, as well as what this implies for central banks and financial supervisors. And before introducing and presenting the topic further, let me start with introducing our 3 panelists that who I thanks to for joining us and accepting to share their views on this panel. Today we have the pleasure to listen to Irene Monasterolo, who is Professor of Climate Finance at EDHEC Business School and EDHEC Risk Institute in Nice, in France. Irene has an extensive research agenda to contribute to understanding the role of finance in the low-carbon transition and the implication of climate change on investment decision and financial stability. She has co-developed climate stress tests for the financial system, which have been applied by several financial supervisors and institutions. And Irene has published research in top and high-ranked journal in this field. Next to Irene, we have William Oman, who is an economist at the International Monetary Fund, the Monetary and Capital Market Department of the IMF. Before this position, he was in the IMF Europe office in Paris, working on topics related to the euro area in France. And his current research focuses on macro-financial linkages, international macroeconomics, monetary and macro-prudential policy, and climate change. William has published what we call a milestone working paper for the IMF on the issue of climate change, which is called Macroeconomic and Financial Policy for Climate Change Mitigation. He holds a PhD in economics from the University Paris 1, Panthéon-Sorbonne. And finally, next to Irene and William, we have Sujit Kapadia, who is head of the market-based finance division in the Directorate General Macroprudential Policy and Financial Stability of the European Central Banks. So his division is responsible for mitigating systemic risk arising from non-bank financial intermediaries and also monitoring financial stability risk, including climate risk to non-bank financial intermediaries. Prior to joining the ECB in 2017, Sujit spent 12 years at the Bank of England as a head of research, and he holds a PhD in economics from the University of Oxford and has published extensive research on macroprudential and monetary policy, climate change, and financial networks and contagions. So before giving the floor to the panelists, let me quickly introduce a bit the issue. So we've spent 3 webinars now, it's the 3rd webinar, talking about how financial institutions and financial markets reflect climate risk in pricing. And let me maybe start by telling you where do we come from on that, let's say in 2018 or 4 years ago. So I think when it comes to integrating climate risk, we face first basic theoretical problems, which is how to measure risk pricing. This is not obvious to do that empirically. There are 3 ways to do that by comparing asset price between each other, but this leaves room to miss a general misalignments of all assets, for example. Another way to test that is to see how prices react to news on certain issues. And here the question is, if they react to the size, the extent of the reaction really reflect the entire climate, the entire risk, or just part of it. And you also have a theoretical model based on fundamentals driving asset prices. And here the challenge with climate risk is that there is no history of how climate change impacts asset prices, because we haven't seen yet what the real impact of climate change on the economy yet. So with this background, the initial evidence that we had, let's say until 2018, were very scarce. Only a few studies on specific asset classes, for example. And I think the results were not really conclusive. You had papers hinting that there were no difference, no pricing, or that you could see, for example, a green premium for green bonds, but this premium could have been positive, which is the opposite of reflecting climate risk or negative. So we had a very heterogeneous set of empirical evidence. And on the other side, also practices by financial institutions like credit rating agencies. We had some doubt whether they were actually integrating climate risk in their process and their rating. So on this background, central banks and the NGFS in general started with the hypothesis or the claim that final climate risks were not fully reflected in asset prices. And Lagarde, for example, had, if I remember well, in 2019, saying that explicitly in an article that she thought that climate risks were not reflected in climate risk. How has it evolved since that? I think we have gathered more evidence, and we have seen some of them in the seminars that we presented in the last two webinars. There is some signs that some markets price some risk, like physical risk, especially. There is less evidence on loans, for example. There is also, we don't know exactly what is priced in. So some models are based on emissions to see if different emissions produce different prices. There are models about news, and it's still unclear whether it is fully reflected or not. So we have more evidence that it is. We don't know if the size of the reaction that we see matches the size of the risk. And we also have the ECB last year coming with extensive study on bank behavior, showing that banks are not really fully integrated in what the ECB expects in terms of climate risk management. So we can wonder whether climate, asset can price climate risk if the financial institutions are not ready to do that operationally. So this has consequences. If prices are not fully reflected, it's basically a market failure. And facing this market failure, what can central bank and financial regulator do? That's what we would like also to discuss today. There is clearly, if there is this market failure, there is clearly a scope to correct that. But what are the right measures to do it? Measure fostering disclosure, or more fundamental measure like changing capital requirement for financial regulation, or adapting asset purchases benchmark to reflect this risk for central bank. This is everything we're going to discuss today. And without further ado, let me start with Irene, who will tell us her views about that. She will be followed by William and then by Sujit. Just before starting, Irene, let me remind you that you can ask questions in the chat or in the Q&A section if there is one, and I will relay your question after to the panelists. That being said, Irene, the floor is yours.
Thank you so much for the kind invitation. It's a pleasure to be here today with you. So let me start with a few considerations. I will be brief and mostly will be interested in your questions. Let me start first with some considerations about market pricing of climate risk when we consider climate transition risk. So as Pierre already nicely said, there has been a growing consensus, in particular in the most recent year, on some type of pricing. Well, this analysis considered the pricing of carbon emissions, and in particular in stock markets. There has been a growing analysis on an agreement on the presence of green premium and carbon premium. However, this gets a bit more complicated when we move to the bonds market. And there is recent analysis found rather different results in bond market prices versus the pricing of climate transition risk in syndicated loans. In particular, in the latter is still questioned. And there is also major evidence of very limited pricing of transition risk in sovereign bonds. In this regard, of course, it's important these are very important pieces of evidence, but when we assess climate transition risk and we ask ourselves whether markets are pricing it, we should not only limit ourselves to emissions, because emissions, of course, are very important in the context of transition risk as a variable, but are not actually the only variable that matters. And plus, they are characterized by large confusion, what was called aggregate confusion in recent research, and in particular, poor disclosure and standardization of information. If you consider that two firms in the automotive sector like Fiat, now Stellantis, and Volkswagen report very, very different scope 3 emissions, Fiat being like several times lower, like 10 times lower than what Volkswagen's report for scope 3. And this is only due to internal model of scope 3 reporting. And well, we can see that this is a major limitation for telling us whether the market is pricing something or not. And then recent research also showed that there is a lack of clarity on the portfolio performance of and issues of greenwashing. In terms of evolution of research and relevance for regulators, so we should also be aware that most of analysis on pricing of transition risk are backward-looking, meaning we use historical time series on prices and for groups of firms or indices, usually green and brown, but there is no use of scenarios. Why we know that transition risk can lead to a structural break, making past data little informative about future risk. And this is something on which we really need to focus in finance research. On the other hand, when it comes to complementing emission variables with other variables that are relevant for the transition and could make a big difference in understanding the shades of green or shades of dirty of a company in which we might want to invest, research has recently developed new greenest measures that consider also the firm technology profile and the revenue share. Also in a forward-looking dimension, I mean, looking at the CAPEX and OPEX. And this is what we recently did with two colleagues and applied to the ECB corporate bonds portfolio to analyze how the ECB could rebalance its portfolio to decrease its climate transition risk. Finally, recent analysis also looked at, applied the EU taxonomy and created actually coefficients to translate the criteria of the taxonomy at the level of financial markets. And this is what Alessio and Battistone did and published in the ECB Macroeconomic Bulletin 2021, where we create coefficients for EU taxonomy alignment and climate transition risk exposure of investors. And this was for transition risk. When it comes to physical risk, there is contrasting evidence, in particular related to pricing in the housing market. On the one hand, Giglio and others found that real estate prices directly reflect climate risk. On the other hand, publication by Garbarino and Guin from Bank of England, published last year in our special issue Journal of Financial Stability, found that banks' valuation do not mark to market against local price declines, and there is no adjustment in interest rate. And they focused on the case of flood risk in the UK. What should we ask in this regard is whether, and this also applies for transition risk, first of all, is how relevant is the adjustment? Because if I find that the market price by 1 or 2 basis points, probably we should ask ourselves also, of course, this could be relevant from and interesting from an academic point of view, I mean, in terms of research in finance and lead us to publish also in good journals, but we should ask when it comes to practitioners and financial supervisors, whether this is enough or this is relevant for our for what we want to achieve. I mean, should market do it themselves? Other limitations and challenges regard again also here the use of climate scenarios. So current analysis has been based mostly on historical occurrences of disasters. And also what is missing still so far in physical risk assessment is the lack of a transparent assessment of the shocks from plant level, the transmission through firms value chain, and the final cascading on investors' portfolios. And finally, in this regard, all these analyses did not take into account a major characteristics of physical risk, which is tail risk. We saw recently in the last years that climate risk, in particular hazards, don't happen in isolation, but can compound, for instance, with the pandemic crisis. And now we see it with geopolitical crisis as well. And what we see in a work done for a couple of years with the World Bank and an application published by Dunz et al., including me, on Journal of Banking and Finance, is that when climate physical risk compounds with other shocks, then the implications on economic growth and financial stability are actually magnified. The negative implications are magnified. And this, of course, poses challenges for financial risk assessment and management. Last but not least, the current scenarios for physical risk that supervisors apply for physical risk assessment, the stress test, only focus on chronic long-term impacts, but neglect acute risk, and which could lead to larger shocks in the short term. So how can financial regulators ensure climate risk pricing when we consider both physical and transition risk? Well, first of all, I think that leading by example and enhancing transparency and coherence of the analysis is absolutely crucial if you want then to lead markets and investors to do something. And the first point from which to start is to check the quality of physical and transition risk data that you use before actually you implement them. And this would have several positive implications. First of all, it will help you dealing with lack of clarity of results. For instance, in recent stress test exercises, where we were expecting to see large shocks from physical risk, and they did not realize, as in the case of the ECB economy-wide climate stress test, and also other stress tests by Banque de France and Banca d'Italia. And the reason is right on what type of risk are you looking at and the scenarios. In addition, public consultation on this on data, also knowing at the growing debate on greenwashing, would really help to build trust also in results and motivate a broader series of actors. The second point on which I would like to focus is the need the importance of integrating scenarios in climate financial models in order to avoid confusion of results and miscommunication, as recently occurred with a quite debated report. And the reason is that integrating climate scenarios into first macroeconomic models and then financial valuation and models and risk metrics is it's very difficult. And it's also very complex, meaning that we need to introduce some assumptions. And that's the best way to explain why we get some results and understand what we still miss is being very clear on the assumptions that we make and how we do this integration. The third point is that we need to look at the future. Climate change, if we agree that climate change is deep uncertain and characterized by non-linearity and endogeneity, then of course, if we look at analysis based on past data, they can be quite reassuring, but actually they will not help us to deal with the big problem that climate change can bring in the future and for which we need to be prepared. Also, because what we saw in a recent paper published with Stefano Battistone is that the financial risk metrics, such as probability of defaults and expected shortfall, are highly sensitive, in particular to the occurrence of high-end scenarios. And finally, and final remark is that when we consider climate scenarios and our current climate stress test analysis, we should be very well aware that they are still missing investors' expectation and tail risk. And these actually, when we consider them, the trajectories would, of the transition and of risk could largely change. Thank you.
Thank you very much, Irene. William, do you want to follow up on that?
Pierre, thank you very much for the opportunity to participate in this panel. The usual disclaimer applies that the views I'll express are mine and don't necessarily represent those of the IMF. The transition to a low carbon economy by 2050 is critical to prevent catastrophic climate change. The latest IPCC report contains a grim warning. Quote, any further delay in global action on adaptation and mitigation will miss a brief and rapidly closing window of opportunity to secure a livable and sustainable future for all, unquote. Despite announcements of net zero targets by many countries, global warming is projected to exceed the goal of the Paris Accord of limiting warming to 1.5 degrees already in the early 2030s. The financial sector has an essential role to play to facilitate the transition to a low carbon economy. Pricing in this transition is crucial from a capital allocation perspective. Today, I'll focus on two questions. First, to what extent are climate risks priced in by financial markets? And second, what implicit signal are central banks sending to financial institutions about the importance of accurately pricing climate risks? So to what extent are climate risks priced in by financial markets and institutions? From an international perspective, a chapter of the April 2020 Global Financial Stability Report of the IMF looked at the pricing of physical risks in cross-country equity valuations based on a sample representing 95% of world GDP. It found that aggregate equity valuations as of 2019 did not reflect physical risk. Baldauf and co-authors in a 2020 paper find that house prices in the US reflect heterogeneity in beliefs about long-run climate risks, while Hino and Burke in the 2021 paper find little evidence that US housing markets fully price information about flood risk. There is some evidence that transition risks are partially priced in. Bolton and Kaspersky, also cited by Irene, find evidence of a carbon premium in US stock returns. Barnett, in a 2020 paper, finds that increases in the probability of future climate policy being implemented reduces equity prices of firms with a high exposure to climate policy risk. The question is, what would full pricing in of climate risks look like? Some estimate climate damages in a business as usual scenario at 25% of global GDP by 2040, a very material impact. The transition requires enormous transfers of resources across sectors, and thus a profound transformation of the economy. Combining the two, it appears that the full extent of risks posed by both climate change and the need to transition to a green economy is far from priced in. This is consistent with survey evidence from GARP that just 6% of firms think that climate risk is fully priced in. There are at least two main obstacles to pricing climate risks. First, lack of comprehensive standardized information on climate risks, as highlighted by an IMF staff climate note on strengthening the climate information architecture. To address this, the IMF has stressed the importance of climate-related disclosures for financial stability assessments, including more standardization and granular firm-specific disclosure on current and future exposures and vulnerability to physical climate risk. The second obstacle is uncertainty. First, about climate impacts beyond those that are highly likely, and the response of human societies, such as mass migrations and conflicts, and their translation into social, economic, and financial impacts. This makes physical risks especially hard to assess. Second, uncertainty about transition risks. The literature shows that carbon prices alone are not sufficient to reach mitigation targets, meaning there's uncertainty about the policies that will enable the transition. There is also large uncertainty about the technologies that will prevail in a low carbon world, and about whether the transition will affect trade flows or trigger geopolitical tensions. Therefore, systematic disclosure of climate exposure data may not be enough for markets to fully price in climate risks. This leads me to my second question. What implicit signal are central banks sending to financial markets and institutions about the importance of fully pricing climate risks? Some central banks have communicated about the relevance of decarbonization policies. For instance, ECB Executive Board member Isabel Schnabel has stated that the EU treaty not only allows, but requires the ECB to take climate change into account. This would seem to encourage financial markets to fully price climate risks. However, there are reasons to wonder how broader policy signals from central banks, both those that acknowledge a role in the transition and those with a more measured stance, affect the pricing of climate risks by financial markets and institutions. On the one hand, central banks across the globe provided unprecedented policy support to financial markets during the COVID crisis. As noted by the IMF, all 17 central banks in advanced economies and 2/3 of central banks in emerging markets took measures, often wide-ranging, to support financial markets during the pandemic. This support mitigated losses in a business-as-usual scenario from a decarbonization perspective, regardless of the possible future impacts on the low carbon transition of the financial activities that were supported by monetary and financial policy responses. This ample support contrasts sharply with central banks' cautious stance on their role in the transition. The NGFS report on central bank operations in a warming world, for instance, concludes that central banks may consider supporting the transition using monetary policy tools where they have a clear policy remit to do so. In this context, is it rational for financial markets and institutions to expect an orderly or a disorderly transition? And what should they expect with regard to central banks' role in the transition? Could the contrast between central banks' support to financial markets in a business-as-usual scenario and their cautious stance on supporting the transition favor continued mispricing of climate risks? A fundamental reason to believe that it could was highlighted by Stern and Stiglitz. One reason they note why goals that are implicit in the behavior of capital markets and firms don't coincide with those of society is that when there are large and correlated societal losses, there is a high probability that such losses will be socialized, even as the profits associated with actions giving rise to those losses are privatized. The knowledge that there will be such bailouts leads to collective moral hazard with excessive risk-taking. The position of the IMF is that financial regulation is a poor substitute for government policy on climate, but that central banks must incorporate climate risk into the prudential framework and create an enabling environment for green projects by strengthening the climate information architecture and ensuring that financial institutions incorporate climate-related risks in their risk management practices and business decisions. An open question that stems from the insight of Stern and Stiglitz, however, is whether, independently of the incorporation of climate risk into prudential frameworks, the implicit signal being sent by central banks contributes to collective moral hazard with respect to pricing climate risks. If this is the case, and I will conclude here, it underscores the relevance of three further open questions about central banks' role in ensuring that financial markets fully price climate risks. First, does the principle of market neutrality imply a carbon bias in monetary policy operations? If so, should it be addressed? Second, could there be a policy role for double materiality, the concept according to which climate change can affect financial institutions and financial institutions can impact the climate system and therefore contribute to the risks they aim to measure? Third, could there be a role for interactions among central banks and other key actors, including fiscal authorities, in enabling the low carbon transition? For example, if the transition requires massive public and private investments. Let me stop here. Thank you.
Thank you very much, William. So a clear start by saying that currently market price do not reflect entirely climate risk, and then some policy conclusion that I would like to take back to the panel later after Sujit introductory remark, if you allow me. Sujit, please.
Thanks. Can you see the slides?
Yes, we can see the slides.
Great. So firstly, I just wanted to say thank you very much for the invitation to join the panel today. It's a real pleasure to be here. The views I'm going to speak to today obviously represent my own views and not necessarily those of the ECB. So what I'm going to focus on today is two broad questions. One is the extent to which climate-related risks may be reflected in financial markets and also in the way in which financial institutions are approaching risk. And then I'm going to talk about some of the policy implications that stem from that, in particular in terms of data and the financial sector, financial regulation, and so on. So just let's start with some evidence. I think both the previous speakers have referred to the left-hand work by Bolton and Kasperczyk, so I'm not going to spend very long on this, but there is some evidence clearly of a pricing of transition risk in equity markets. And so what they find in terms of the left-hand chart is that the stocks of firms with higher total carbon emissions, which is the blue, and worse changes in emissions, which is the yellow, have higher stock returns, and that's after controlling for standard factors. Now, what that means is that those firms have a higher cost of capital, suggesting that investors and shareholders are already demanding some compensation for their greater exposure to transition risk. And what is shown here in the charts is the difference in monthly stock returns in percentage points for emissions that are one standard deviation above the average level of emissions for firms. And that translates, if you multiply up these numbers, into 2 to 4 percentage point higher returns on an annual basis. So that's economically meaningful. Perhaps maybe a little less familiar, but it's based on some of the work that I've done with some ECB colleagues, is shown on the right. So focusing on debt markets, but in particular on credit risk. What we've looked at here is the impact of various measures of transition risk on credit risk, both as measured by credit ratings and by the market implied distance to default. So what the chart here shows is some of the credit rating results that we find, but the results also broadly hold for the market implied distance to default. So what you see in the blue is that higher emissions worsen credit ratings for firms, and that is by nearly as much as a one standard deviation change in leverage. So credit ratings are reflecting emissions to some degree. On the other hand, disclosure of those of emissions by a firm is positive for credit ratings. And you see that in the disclosure emissions dummy in the middle. But what's also interesting is that firms with a forward-looking target to cut their emissions, which you see in the fourth column, have lower credit risk, with the effect tending to be stronger for more ambitious targets. So this points to the importance of forward-looking plans in terms of potentially helping to reduce credit risk, though clearly those plans need to be credible. So overall, what does this say? It says that there is some pricing of transition risk in financial markets. Now, the question of whether that is the right extent, or the right amount of pricing is clearly a much more difficult question, and is very open to debate. Let me turn to some evidence in relation to the financial sector. So in the left-hand chart here, what you see is something from a broader piece that the SSM published in relation to how European banks were currently adjusting their practices to manage climate and environmental risks. And it's overall, it's a mixed picture in terms of how the banks are currently adjusting their practices. The report, in broad terms, finds that banks made most progress in adapting their governance. So, for example, their formal responsibilities. And some banks have started to incorporate climate and environmental risks into their lending policies. What you see in the chart on the left is that 2/3 of banks have made meaningful progress in terms of integrating climate risk into their credit risk management. And the way you get to that 2/3 is that different banks are doing different of these policies that are shown in the left. And so the blue, if you sum across the banks, 2/3 are reflecting climate risks in some way in their credit risk management. Most have started with adapting policies and procedures, which is what you see in the bottom two bars. But in terms of perhaps more ambitious approaches, so portfolio monitoring and management and loan pricing, as you see in the top, institutions are still in the early stages of development. And beyond this just focuses on their credit risk treatment, but beyond this, it's fair to say that only a handful of the banks are mentioning actively planning to steer their portfolios on a Paris compatible trajectory, and that there's a clear sense that more needs to be done. But there is some evidence here that there is some reflection, or starting to be some reflection, in the banks of climate risks in terms of their portfolios. I should say here, credit risk here refers both to physical and to transition risk. One other additional point that I think is quite interesting here is that we tend to think of mispricing as being the problem, but it's also worth flagging that when climate-related risks are in fact more priced, that can also create particular issues. And what I want to show on the right-hand chart is an example from the insurance sector. What we see here is that there is already evidence that increasing physical risks are reflected in a withdrawal of insurance coverage from particular catastrophe-prone areas or a higher pricing. And what we've tried to do together with some colleagues from AOPA in the study on the right is to look at the impact of a potential growing insurance protection gap, which will be created by effectively a greater pricing of physical risk, if you like, by insurers on GDP. And what you find if you compare the case of the current insurance level with no insurance is that under a severe scenario, so this is under a 3-degree temperature increase by 2100, the differences in insurance coverage could have very material effects on GDP. So the difference between assuming full and no insurance is around 3% in 2050, but around 14% by the end of the century. So potentially pricing of climate risks can also create potential policy issues. So last slide, turning to what does that all imply for policy. I highlighted here 4 main areas where I would see potential policy implications. I think the first is most obviously in terms of data gaps. And I think here in particular, the big data gaps that need to be filled better to allow for a better pricing of climate-related risk will be especially on physical risk exposure, so that the exposure, for example, of firms, but also firms throughout their entire supply chain. Adaptation measures that may have been taken, which is also related to corporates, but also financial institutions. And also better granular information on insurance coverage of exposures. I think that's all important for a better understanding of risk, of physical risk. On transition risk, I would say that the data is perhaps slightly better placed, but where the big gaps are maybe on forward-looking transition exposure plans, but also information on green investment, green loans, and the activities that firms and financials are taking to foster the transition. On the corporate side, I think there's a clear need for enhanced climate disclosure And in particular, a better information, as I've already alluded to, both for corporates, but also for financials on the forward-looking emissions targets that they have, and a greater clarity on the transition plans with milestones. So, for example, the European Commission has recently put forward a proposal for a legally binding requirements for institutions to develop, implement, and disclose transition plans in relation to the Paris Agreement. And that's really important. The content and the milestones of those are key. I also mentioned, in terms of disclosure, there are some key initiatives, TSFD, IFRS, CSRD, which are really crucial in getting better information on reporting on transition risk, which will help with better pricing and better information in the market. Turning to banking and insurance, I think there's a clear need for supervisory action, and I've already spoken to some of the work the SSM is doing in this space. I think there's a role for climate stress tests to better probe the vulnerabilities of both banks, insurers, and other parts of the financial system to different scenarios, and Irene already talked about some of those issues. And then finally, in terms of the prudential framework, I think it's going to be important to assess whether sustainability and climate and environmental risks are adequately reflected in the current prudential framework, and also assess whether there is consistency across approaches, for example, between the standardized approach, which rely on credit ratings, which, as you see, do seem to reflect climate risk to some extent, versus internal rating-based models. And on the right, I've listed some of the key bodies that are looking at these issues, the Basel Committee, FSB, and GFS. But it's also linked to the Commission's Fit for 55 stress tests and packages as well. Lastly, on the insurance protection gap, which, as I said, is quite a different issue, I think we need to look at mechanisms that potentially can help to close that protection gap. That may need private insurance, it may need public-private partnerships, but there may be also a role for a sort of wider disaster fund type setup. EIOPA is looking into this quite heavily. It relates to some of the EU strategy, but there's also a wider global debate here being conducted by the Insurance Development Forum on measures that help to address this insurance protection gap, which may be created by a better pricing of climate risks. With that, let me stop and hand back to Pierre. So thank you very much.
Thank you for your first remarks. So we don't have so much time remaining. Let me start with one question on disclosure. So this is something that you highlighted all, and that a lot of people highlight in general, that it's a lack of data that is hindering the pricing of climate risk by financial markets. So my question, especially in the light of what you said, William, is disclosure enough? So do you think that, if we have perfect disclosure, then this will mechanically lead to a free price? Or are we in a more fundamental problems where you are, as Nick Stern and others have said, that there is like a market failure, and that objectives do not coincide between financial markets and society. So maybe let's start with you, William. What is your take on that? Is disclosure enough? And if it's enough, or if it's potentially enough, what central bank and financial supervisor do so that financial participants do use this information and start acting on them? Do you see any obvious things that they should do? Or, and if you don't want to answer this question, I can go directly to someone else.
Maybe I can give a two-handed answer as a good economist, but I think the view of the IMF is that strengthening the climate information architecture is critical to promote transparency and global comparability of data, and this will improve market confidence and protect financial stability and foster the development of sustainable finance. So the IMF has put forward some recommendations on a globally coordinated effort move different building blocks of a climate information architecture with high quality data, globally harmonized set of climate disclosure standards, and globally agreed principles for climate finance taxonomies and other classification approaches. My personal view, and this is not necessarily the view of the IMF, is that there's very suggestive evidence that disclosure is not enough. So if you look at what's happening in the fossil fuel industries, as documented by Brett Christophers, fossil fuel producers can still get finance in primary markets, and this finance is still affordable. There's no evidence that the cost of capital for fossil fuel producers is being increased to a punitive rate. Another development that he documented is that Western fossil fuel assets and companies are currently increasingly owned privately rather than publicly, as more privately held firms choose to or are forced by market conditions to stay private. And this means that there's less scrutiny, less disclosure. And I think there's strong evidence of the opaqueness of the fossil fuel industry in terms of its activities, and very difficult to obtain information on these types of companies, including national oil companies, for example. So for me, the notion that disclosures is enough is really raises challenges. I think it's far from convincing at this stage.
Sujit, can I have your take on that? Is disclosure enough? Like perfect disclosure would solve everything, or do we need to take other action to kind of give the incentive to financial institution to act on the data and then to reflect climate risk concretely in their action?
So I think disclosure is clearly helpful and valuable. And the point I made on data gaps is that I think we need better information, and that will certainly help financial institutions and other players better assess climate-related risks. But I think it's not. I think we need more than that, which is why I talked about some of the other measures that were on my last slide. And I think so. I think, for example, I mean, you can talk about this, you can think of this as disclosure if you like, but I think it's a fine line. But having credible forward-looking plans at the corporate level, at the financial institution level, about how you're going to transition towards a low-carbon net zero economy, the milestones that you're going to do for that, but the investments that you're going to undertake if you're a corporate that are going to help meet that, I think is going to be so having a clearer expectations in that space. Clearer expectations from a supervisory perspective, and that's what the SSM is trying to do. It's also about making sure that the data that is out there is exploited and used. I think there is clearly still a sort of tragedy of the horizons perspective here to climate-related risks, as Mark Carney put it several years ago. And so you can have all the data in the world that you want, but there may still be that tragedy of the horizons, which may require actions in some of the other spaces, including some of those areas that I talked about. So I think overall disclosure is clearly helpful, valuable. Filling data gaps is very important. But I think there needs to be, a stronger role. And the key thing I would also say is clearly this stretches well beyond the role of financial regulators, central banks. Carbon taxes and the effective pricing of carbon, I think, has got to be a key part of the solution. That's a matter for governments, and it's not a matter for central banks and regulators. But in some ways, governments have to be the main player here, and disclosure can only help so much, but a carbon tax would really sharpen incentives much more than disclosures would in terms of the pricing of the carbon risk, because it's a clear incentive device mechanism.
Yeah, talking about disclosure, you mentioned that a lot of relies today on disclosure of emissions, and you suggested that this is not the most useful information. So what do you think would be the information that firms should disclose better to inform investors and financial regulators. Does your research already suggest which kind of information goes beyond emission and is to give a better sense of climate risk?
Yeah, thank you, Pierre, for this question. Sure, emissions are important, but not so variable to consider. And in particular, in order to understand how good or bad a firm could behave according to transition scenarios, such as the scenarios, the NGFS, a key role is played by the energy technology profile of the company, because this gives you actually an idea of how well the firm is preparing to face the scenario and thus the potential performance. And our recent research, for instance, the one that I mentioned before about climate transition risk exposure of bonds in the ECB portfolio or applying a new greenness measure, shows that when you account for energy technology profile of companies, on the one hand, you have an advantage of being able to clean up some of the noise that there is currently in emissions data. I mean, the last one to talk about it was CDP, Carbon Disclosure Project, saying that only 1% of companies disclose fully on their 24 indicators. So on the one hand, you have the advantage to be able to overcome some of the challenges of the greenwashing, so some noise actually that then matters when you do your regressions. For instance, the example that I made before about automotive companies. On the other hand, you have also the advantage to be able to capture a forward-looking dimension of the firm by looking at the revenue shares that they allocate according to their activities by energy technology, so their CapEx and OpEx. And we know that this is very important to see how the company is going to position. I mean, what's the idea that the company has of itself in the future? What's its strategy? And this is already the information that is already available. So it's available, however, on from different data providers. And this is why it took us so long to develop a standardized database model. But it's not the fact that data is not easily available, or not as easy as going on Asset4 and download the emissions, should not be an excuse, because if few academics can do it, then probably it's also financial supervisors could start to work on this and take data providers with a bit more critical sense, or a sense of doubt, because then if we if we go on like this, we might have looking at the speed of increase in sustainable finance in the last 3 or 4 years, in a couple of years, all the financial market would be sustainable, but we would not have solved the problem of not having such a large increase in green investments in the real economy, which are those who are needed to make the transition. And we might realize it in 5 years that, oops, we made not all the green that we would imagine is so green. And then if we realize it in 5 years, then it will be too late, according to the last IPCC report. And just let me, a final remark on physical risk, because most of the analysis so far is focusing on transition risk, but thinking that physical risk, however, is more high long term. But acute risks are already with us, and in particular in several both high-income and low-income countries. And in that case, physical risk, data for physical risk are even more challenging. And in this regard, plant-level information and a clear pipeline to move from plant-level information to firms' business lines and investors' portfolio is needed. We try to assess it in a paper that we are publishing and presenting at the Risk Forum in Paris in a couple of weeks, only using public accessible data. But of course, again, supervisory information would really be very helpful to complement. Last but not least, because the fact that when we consider physical risk, some of such risk might not be hedgeable.
Thank you. I'm just reading one question from Adel Maurice here, and I'm trying to summarize it. It's quite long, but you know, the transition risks not only depends on emission level, but also on abatement costs and the ability to pass them through to pass the carbon price. And so why do you think there is so much attention on emissions and so little attention, so little consideration about how this policy actually, the carbon policy actually impacts them?
May I go from an academic point of view, why there is so much attention, very briefly, because you have a time series of emissions with which you can do nice regressions and publish publish standard analysis.
Let me maybe go back to what you suggest, what you hinted to William on the prudential framework and the need to maybe revise the prudential framework to take climate risk into account. So what you know, in the light of climate risk, what do you think are the key revision of the prudential framework that financial supervisors should undertake? Is it you know, Pillar 2 measure about financial institution behavior and risk management? Is it about addressing the systemic dimension of climate risk, maybe reflecting that in a capital buffer? Or is it going into capital requirements, for example, that a lot of people claim are not reflecting climate risk at all now? So what do you think the right level of or to address climate risk? And I would like the same question to Sujit to maybe conclude the panel.
I think maybe Sujit is better placed to answer that question, if you don't mind.
I mean, I can have a first go. I mean, like I think, as I said, I think the prudential framework should, you know, its main purpose is as a risk-based framework. So now I think what we need to understand is whether the prudential framework adequately captures the climate and environmental risks that are out there. And so I think at the moment it's important to just understand and assess those dimensions. So to the extent, you know, so to get the evidence that I put on credit ratings, to the if and this is a big if you, I think credit rating agencies should be clearer, I should say, on disclosing their methodologies and explaining a bit more clearly how they reflect ESG considerations and so on in their credit ratings. There's a separate point to be made there about credit rating agencies. But if you look at the evidence that I presented, there is some evidence that credit ratings are reflecting, to some degree at least, transition risk. Now, credit ratings are also central to the standardized approach for prudential capital requirements. So to the extent that credit rating agencies adequately reflect, which is a big question and it needs more information on the methodologies and understanding of that, but to the extent that credit rating agencies adequately reflect climate risks, then that will translate into the prudential framework for those institutions using the standardized framework. But that does not necessarily mean a translation into those using an internal rating-based approach to set their capital requirements. So then we need to understand whether there's consistency across those approaches in a broad sense. IRB is never going to be fully consistent with standardized, but in all sorts of other dimensions. But you know, in a broad sense, that the risk categories are reflected. And then this takes me back to the sort of the SSM exercise, which is trying to understand to what extent banks are reflecting the risks in the way in which, as I showed you in the slide I showed you, was focused on essentially the part of the book that speaks to the key part that speaks to capital, which was on their credit risk management. And so the way I think about it is it's important to understand those dimensions. It's a difficult quantitative question. It seems to me there are some climate risks that that are inherent on the portfolios of financial institutions that ought somehow to be reflected. How you do that quantitatively is challenging. There needs to be consistency across different approaches. But I think, yeah, this is a key area which, you know, as I say, there's active work at the BCBS, the FSB to look into these issues, the EDHEC as well. And I think it's, you know, it's important to understand this from a supervisory and macro-prudential perspective. So I think it's a bit early to say definitively what should be done. It's important to be clear what the prudential framework is for, but I think certainly it's an issue that warrants further reflection, further assessment along the lines that I've been just describing.
I might just maybe end up on a provocative question, but let's say I know that the ECB is now looking at to which extent climate credit rating agencies are addressing this issue. You know, as you say, it's an issue that also the Basel Committee is looking at. Let's say that in 6 months, they discover that both internal rating-based approach and the standard approach do not really reflect climate risk. Then what would be the consequence? Should that lead to a kind of an add-on, capital add-on to reflect that? So which I mean, that's what I think basically. If it's not reflected, it should. Do you see that in another way, or which?
I mean, I would broaden it out a little bit. I mean, if you identify that there's a clear risk anywhere in the prudential framework that is not adequately reflected, and it could be cyber risk, it could be a whole host of other risks. It could be the risks from crypto assets, which is another active area where what the BCBS is trying to look at the risks from crypto assets. Do they pose risks to financial institutions? I think you need to, if you find that things are not adequately reflected, then you need to see what you may want to do about that. But then there are different measures. You can look at that through a supervisory approach. You can look at that through a prudential approach, and different types of the toolkit may be different depending on exactly the nature which you find. So it's a difficult question to answer in the abstract about, okay, something is found as a gap. If you find a gap in some risk that is not, you feel is not adequately captured, whether it's crypto or cyber or climate, I think, yes, you would want to consider doing something about it because the risk is not priced and there's a financial stability, a microprudential and a financial stability risk that stems from that. But the precise nature of the measure, I think, depends on exactly what you find the gap is, where you find it, is there a difference between IRB and standardized, those sorts of things, for example. So it's a bit difficult to say in a sort of abstract sense which way you would definitively go. But in a big picture sense, yeah, if there are gaps anywhere in the risk framework where we think a risk is not properly captured, then I think it is important to consider how you fix that.
So I didn't check the time, but we already over time. So I just, if you want to add a few words to make things clearer about what has been said, or just make a point, it's your last chance to all of you. And if not, let me thank you again for accepting to participate to this panel. I think it has addressed a crucial question. I'm really happy that you could give your views on that. Very insightful. For the audience, so we will now move to our next series of 3 panels on a different issue, and the next series of 3 webinars will be on the distributional impact of climate change and climate policy. And the first presentation is will take place on March 28th. It's a presentation by Diego Kensick, who will present his paper, The Unequal Economic Consequences of Carbon Credit Pricing, which is a paper for which he got awarded the 2021 ECB Young Economist Prize. So a timely issue, a distributional issue, and a promising paper for the next seminar. Thanks a lot to you, Irene, William, and Sujit, and to all of the people joining. See you in 2 weeks. Thank you very much.
Thank you so much.
Thanks very much.
Thank you very much.
Bye.